Hey, what's up, YouTube? Casey Dimon here, TaxSaleAcademy.com. Hey, thank you so much for joining me as I record this episode for the Tax Sale Podcast. As always, if you do enjoy listening to podcasts, check us out. There's a link down below in the description. It'll take you to TaxSalePodcast.com, where you can download us on your favorite podcasting platform and you can take us on the go. But if YouTube is more your style, that is perfect with me. Just let me know by clicking that thumbs up button. And also, don't forget to subscribe to our channel. That way you don't miss out on future tax sale training videos. And you can do that by clicking the red subscribe button. Let's go ahead and switch on over and record that audio podcast right now. Welcome to the Tax Sale Podcast, where tax sale investing is made easy. My name is Casey Dimon. I'm a tax sale veteran. I'm the leading tax sale expert. I'm the author of the Tax Sale Playbook, founder of the Tax Sale Academy, and I am your host right here on the Tax Sale Podcast. Thank you so much for joining me on today's podcast episode. This is a completely free podcast and is brought to you through and because of the Tax Sale Academy. If you're looking to learn more about investing in tax default real estate, just head on over to TaxSaleAcademy.com. Again, that's TaxSaleAcademy.com. On today's podcast episode, we'll be talking about tax liens. Specifically, we'll be discussing tax liens that have the highest chances of going right through the redemption period without being redeemed. That way, of course, you have the highest chance of becoming the owner of that property. Now, let's jump back just a little bit to get you caught up on what a tax lien is if you're not familiar. So, when an owner will fail to pay their property taxes on time, the county is obviously going to be impacted since they aren't able to collect the funds that they rely on for their budgets. Those budgets, of course, will fund law enforcement, fire rescue, roads, sidewalks, parks, bridges, schools, and so much more. Many of the things that we probably take for granted but use every single day. Those taxes are required for the county to operate like we know it. So when those taxes are not paid, the county must take some sort of action. Now, in a tax lien state, shortly after the taxes become delinquent, the county is going to sell what is known as a tax lien against that property. Essentially, an investor like you or like myself will step in and we will buy that tax lien. When we do it, we are basically paying the taxes on behalf of that delinquent taxpayer, which allows the county to get the funds that they need to fill their budgets up and also puts us as the owner of a priority lien against a parcel of real estate. And in exchange for doing this, we are going to earn interest on our money. The owner of the property, that delinquent taxpayer, will have a window of time to come in and make those payments. That could be 2 years or 3 years. It just depends on the state. When they do that, when they come in and pay those back due taxes, they'll also have to pay some fees and the interest that we are due. They make the payment, we collect our initial investment plus interest, and then that lien, it's gone forever. If they don't ever pay those taxes, we can, as the tax lien holder, foreclose that tax lien. That way, we will become the owner of that property. Now, some tax lien holders will seek out liens that will be redeemed. They are more focused on earning interest on their money rather than going through the effort to foreclose on that property and having to resell a parcel of real estate. They just want that interest. And the truth is that the large majority of tax liens do end up getting redeemed prior to that redemption window expiring. Now, we're going to discuss that specific strategy on next week's podcast episode. Now, on this episode, we'll be talking about the other investors, the ones who are interested in the returns, but would rather own that property when it's all said and done. So I always tell investors to invest in tax liens if you're looking just to earn some interest on your money. That'll beat most markets. Invest in tax deeds if you want to own a piece of property. It takes the guesswork out of the equation. But with that said, there are many investors who do want to invest in liens, but they would prefer the ones where they're going to have the highest chance of eventually acquiring that property through tax lien foreclosure. So instead of, say, the national average of maybe being able to foreclose 5 out of every 100 liens that you invest in, they want to better their chances so they can maybe foreclose on 20 or 30 out of 100 tax liens. That is who this episode is for today. I'll be discussing a few of the properties to look for that have the best chances for you of going through the entire tax lien process, that redemption window, without being redeemed by the owners. The highest chances of you taking that lien and then becoming the owner of that property yourself. Again, this isn't to say that all these situations described will end up with a lien not being redeemed. But if you focus on a slightly higher percentage of these types of properties, you'll likely increase your chances of being able to acquire a property through the tax lien system compared to just going at it randomly. So with all that said, let's go over the different types of properties attached to the liens to focus on if you're looking to increase your odds of getting that property once that tax lien redemption period is over. The first one is vacant land. In terms of tax sales, vacant land is an extremely popular product type that is going to be sold. And the reasons are endless, of course, but generally speaking, you can use a home. That home you live in is much more valuable to you than that lot that you own on the other side of the country, right? So you can use that home, whether you live in it or maybe just rent it out to somebody. Vacant land you can't use immediately without some sort of additional effort, like building on it, which can be very expensive, of course. It's also one of the first things that people forget about, or they just lose interest in as their plans change or as they move away. So people tend to let their vacant properties go much more often than properties that have structures on them. Another one will be structures, but it's going to be those structures that you might not want. I've seen a lot of dilapidated structures sold through the tax lien system, and most of those have gone all the way through the tax lien redemption period without being redeemed. And many of those will have some special surprises along with them, like city or county liens, which often won't be canceled in the event you do foreclose that lien. And after owning that tax lien for a year or two, waiting for that redemption period to expire, well, that means you have another couple of years of that property sitting there in the elements in disrepair. Many owners of these properties know that those properties have gone far too long without maintenance to be salvaged. So they'll simply let them go without any real purpose to pay the taxes on them. And these are going to be the types of liens that likely won't get redeemed. But you might want to ask yourself if you really want to own that property in the first place. Along the same lines are the properties that lack overall desirability. And I actually train people how not to buy many types of real estate. Some could simply be in areas where there is just zero development. Others could be worthless strips of land. Some could be homeowners associations, parks, or water retention areas, stuff like that. It could be landlocked parcels. There's a whole bunch of other properties just like this will have tax liens against them sold at auction. Naturally, there's a significantly higher chance that the owner will not come in and redeem those properties. Of course, again, you need to ask yourself if you want those. And if you do, you better have a very specific strategy that you're going to be using to profit from those properties. Another one are the liens in the economically depressed areas. If there was a major employer who recently shut down operations where many people lost their jobs, you can guarantee there's going to be a lot of homes that have tax liens sold against them from people who have simply left town and they don't want anything to do with that house anymore. And those taxes will go through the redemption period without being redeemed. Now, obviously, you must make that decision if you really want to own real estate in that area. But in my experience, it isn't so bad if you have a good plan set forth well in advance. Take the time to figure out that plan, then consider investing in those liens. That way you can help out that economically challenged area. And again, if your plan is accurate, if your plan is good, you can make it very, very successful for yourself with a minimal amount of competition. Now that we've talked about a few different property types, let's discuss owner types. So as you're doing your research, you actually just scan through the property records for these types of owners. The first type are going to be the out-of-area owners. Many people will buy property in other parts of the country or other parts of the world with excitement, only to have that excitement kind of wane over time. Others will simply change plans and not care anymore. If you see somebody out of town, that's going to be a good sign for you. If they're out of state, that's usually a better sign. And if they're out of the country, that's even better. I've purchased many liens that were owned by out-of-area owners. And even if the property is redeemed, it usually going to take them slightly longer than the local owner, so your return, your interest rate, is going to be higher. So check the mailing address for the tax bills and look for the city and the state or the country and let that help you decide what to buy. Odds are, if you take the stats and you compare every out-of-country owner, they are going to have a much, much higher percentage of going through that redemption period without being redeemed. Another common occurrence for liens that end up going unredeemed are those held by estates or heirs. In most states, when a property owner dies, the property doesn't just magically go from the deceased to the next person that wants the property or has a claim to that property, like a child, right? Instead, a certain process must be followed to transfer ownership according to the wishes of the deceased. In many cases, the deceased simply doesn't have any relatives. In other cases, the person that does end up with that property, maybe the third cousin or the child or whatever it may be, they don't want anything to do with that property in a city that they have never heard of before, right? Especially when that tax bill comes and they have to pay a few $100s or a few $1,000s to keep that property that they don't care about in the first place. And that's going to be a good chance that property has a tax lien that goes throughout that redemption period without being redeemed. Another one are the properties that are owned by defunct businesses. And this is extremely common amongst some very speculative developers and investors. They'll buy the properties in the name of a company. That company will then have financial issues. Sometimes they might consider liquidating the property or getting whatever they could for that property. But that might mean that they are forced to satisfy other judgments against that company, and it's not worth the effort, right? Why waste all this time and effort trying to sell a property when the company's going to go bankrupt no matter what, right? So they'll let it go through that tax foreclosure process since it now serves no value to them personally, and it's only attached to a non-existent company. And the last one are the commonly delinquent owners. If you see a company or a person that has 50 or 100 liens being sold against them, do a little bit of research. Figure out just how capable you think they are of paying those liens. So do that research, see what their story is, and if you can figure it out, then you might stand a very high chance of acquiring those properties. A few years back, I ended up with numerous homes from an investor who could not pay the taxes on those homes. The reason? He was locked up. He was in prison on fraud charges and ended up losing dozens of homes. So hopefully this kind of gives you a better idea on what to look for when it comes to tax liens being sold if you seek out to become the eventual owner of the property. Now, obviously, regardless if you're investing to get the property or just for the return on your money, you want to make sure that the real estate backing that lien is going to be worthwhile based on your specific investment objectives, because that's going to be the most important part of this business. Make sure that real estate is worthwhile. I truly hope that this episode has helped you out. If so, please do me a huge favor. Take just a few seconds to leave some positive feedback on whatever podcasting platform you're listening to us on, as it really makes quite a difference for us. And as always, if you are interested in learning more about investing in tax liens and tax deeds, there are a bunch of incredibly helpful links in today's show notes, including one which will take you to our primary website, which is at taxsellacademy.com, where you can join the Academy for our most comprehensive step-by-step training system that we offer. Again, I truly hope this episode helps you out, and this entire podcast has helped to make just a small positive difference on your tax sale business. Hey, take care. Bye-bye.